Well, a newly released Bain Co. report reviewing Southeast Asia private equity shows the market was already slowing last year with fewer deals and weaker exits. Now, the conflict in Iran disrupting oil flows is proving to be another headache for investors. Olivia Marzuki finds out more.
2025, which is the calendar year, was a slow year.
Exit is certainly an important thing that does keep investors up at night in Southeast Asia.
As of today, yes, there is a gap between bid and ask.
A look into Southeast Asia's private equity scene found stagnation in the market in 2025. Private equity is when investors buy companies, try to improve them, and later sell them for profit. Well, right now, that last step, selling or exiting, is proving the hardest. Bain Co. says deal value fell 10% on year to about $14 billion across 84 transactions. The recovery remains uneven, with value concentrated in a small number of large deals. Exits are still the biggest drag, with value falling 32% in 2025. PE firms mostly sold assets through trade sales, not IPOs, as they held assets for longer. Older investments built up, making secondary sales a more important way to get cash back.
And when IPOs are difficult to do, then strategic buyers becomes even more desirable exit option. So that is certainly where investors in Southeast Asia are going to be looking, so exits to other financial sponsors, because there's certainly no shortage of capital that is waiting to be deployed.
A lot of corporates has been looking around the region. It's a market entry. It's a difficult market to navigate, especially for countries like Indonesia, Malaysia, Thailand, and Philippines. So the best way for them to get a market entry is to acquire or invest in a local business that's probably has been professionally run and invested by the professional investors to streamline governance, to streamline the business control processes, institutionalize the business.
Investor maybe wanted to exit, but at the same time, we don't see the exact offer that were expected in front. This is, I think, at a shifting point, though, as we can see with the interest rate getting a bit lower and regulated by the bank. So we may see some more transaction, but I think this is one of the main issues. It's really hard to compare Asia and Southeast Asia to what we have been used to see in America and Europe. It's a totally different type of market.
This year, investors are also watching the risk of energy disruption and oil price shock tied to the Middle East conflict. Still, against a tougher macro environment, some sectors are holding up. The artificial intelligence theme tops the chart, as well as the infrastructure supporting the AI expansion, such as data centers.
There's been a significant flow of capital into data centers. Malaysia is a material recipient of capital. Indonesia is important. Thailand is going to start to become important. Think about things like power. You think about things like cooling. Those are going to bring about their own set of ancillary opportunities.
There will be a lot more data, a lot more analytics can be done, understanding what the consumer wants. And AI can actually help to predict consumer patterns, consumption patterns that will take advantage of data that is being collected.
I think as of today, it's really, really hard to assume that any business in the world can be waterproof at 100%. But anything that is alternative real estate, I think, stay extremely on top of the market. But obviously, you have more aggressive investors looking for alternative and real estate, such as the data center industrial.
So with investors still riding out the 2025 slowdown, they now have an oil shock and lingering trade tensions to contend with, while putting their money to work in the region's long-term growth engines.